Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
Matt Justice here for Tackle Trading to start a new a video series for trading currencies. I know a lot of you are very new to trading currencies, and so this video series that we're going to call the Forex Trading 101 series is put together so that you can really start to understand the basics of trading currencies, and at the end of it, we'll put everything together, and we'll release it as a series of its in and of itself. So here, what we're going to call the Tackle Trading Forex Trading 101 video series. Now, your author right here, obviously, Coach Matt, our resident Forex guru over there at Tackle Trading. Now, Forex trading is growing in popularity. Number one, it's becoming, it is probably the number one tradable instrument in the world with 5.3 trillion US dollars exchanged hands every single day. It's the number one trade in the world is called the carry trade, which includes selling the dollar, buying other currencies, and getting to carry the positive interest rate. Every institution, corporation, government trades currencies. Every consumer trades currencies. If you travel to a foreign country or to exchange your money to use some other currency in the local marketplace, everybody invests in currencies because you have currencies in your piggy banks, in your checking accounts, in your retirement accounts, and those currencies are called a free floating currency, which means the value goes up, the value goes down, which impacts your buying power. Understanding and trading currencies is vitally important to protecting, number one, but it's also vitally important to making sure that you secure your financial future. And one of the biggest reasons why people can never retire in America as a consumer or anywhere else for that matter is because they don't understand currencies. They don't understand currency devaluation, fiat risk. They don't understand inflation and how that impacts buying power. And we all know it. We all know that $100,000 today doesn't go as far as it did 10 years ago, or 50,000, or 200,000 for that matter. It's everything is becoming a little bit more expensive out there. So why Forex? Number one is the U.S. dollar and the reserve status. We live in a historical time when we are going through an unprecedented change in our currency systems, in the reserve systems that have been in place since 1944. But we've always had a reserve status. Since ancient Greek times, we've had some type of currency used as a reserve, because all a reserve currency is it's the common currency used in international trade. And as the U.S. dollar is losing its reserve status, which we'll talk about in later segments of the Forex Trading 101 series, something's got to replace it. Whether that's the euro, the RMB, the NDB, or the creation of the ESDR within the IMF. Something's going to replace it, which means the dollar will devalue over time, which means if you have US dollars in your checking or savings account, you're going to lose buying power unless you do something about it. Number two, the petrodollar. The petrodollar is one of the biggest risks to the US dollar. Since 1973, the sale of oil has been priced in U.S. dollars, which means you had to own U.S. dollars to buy oil from, the Sauds or from OPEC or anybody else for that matter. And that's starting to lose its relevancy. In 1999, you started seeing a shift from the U.S. dollar being used to purchase oil. 90% of the oil market was financed in U.S. dollars. Now that number is less than 50%. In fact, even Saudi Arabia is selling oil to China in non-US dollar transactions. They're actually using the renminbi, the RMB, to purchase oil from Saudi Arabia. Next is quantitative easing. The world has gone mad. And what I mean by that is the central bankers in the world have lost their collective minds. And they've started one of the largest currency wars that we have seen in our existence, with almost every central bank lowering interest rates. We've had over 530 interest rates in the world world be lowered in over the course of the last 6 years. You've already had 30 interest rates lowered just this year alone. The U.S. has printed $4.7 trillion in quantitative easing to purchase bonds. The Europeans are now doing over €1 trillion to do the same thing, and the Japanese are doing 80 trillion yen a year in terms of purchasing bonds and infrastructure and ETFs in the marketplace and whatnot. So when the world has gone mad from a printing of money perspective, these things have real impacts in hyperinflation and devaluation, which means you absolutely have to learn how to trade Forex, because even if you don't actively trade it, but you become aware of what's happening, you can protect your money. You can exchange your money for stronger currencies. But one thing you always have to remember is that regardless of whatever negativity there is out there, there is always a positive version of that. And so when we talk about some of the things that are impacting the dollar historically, then obviously that's a negative when you're a consumer here in the US and you use US dollars to purchase goods and services. But if you understand these principles, you can protect your money and you can grow your money as the dollar loses its status. Now let's go through a quick history of the US dollar. The US dollar was created in 1913 along with the IRS and the central bank. The IRS taxes, the central bank's charges interest on the US dollar. So the central bank, which is a private organization, prints the US dollar, of which then the IRS will tax gains on the dollar. Now from 1913 to 1944, the US, which was becoming the #1 economy in the world, it was not the reserve currency of the world though. It was just another currency. The reserve currency of the world at that point was the British pound. But at the Bretton Woods Agreement of 1944, about 200 different nations agreed to the US dollar becoming the world's reserve status as tied to the value of gold, otherwise known as a gold standard. What that meant is that anybody could exchange US dollars, the paper currency, for real gold at $35 an ounce. That lasted until 1971 when they removed the gold standard from the US dollar. They replaced it with what's called a free floating system. We'll talk about that in just a little bit. In 1973, Henry Kissinger and Richard Nixon went to Saudi Arabia and made an agreement with the Saudis to price oil in US dollars. In 1975, that expanded to all of OPEC, which meant 90% of the world oil market, which is one of the largest markets in the entire world, and the #1 commodity out there was tied to the US dollar, which regardless of the gold standard being removed, you still had a commodity backing because of oil is a very precious commodity. In 1999, China and Russia start making agreements to leave the petrodollar, first with Iraq and then obviously with other OPEC nations over the course of the last 15 years. And here's the big one though that really is striking to me. The rest of the world over the last 3-4 years has spoken. They've all called for a new standard, but what China has been doing is absolutely amazing. In 2012, China makes international trade agreements with Japan, Australia, Russia, India, South Africa, and Brazil to use non-US dollar transactions in international trade. In 2013, the United Nations and the IMF call for a new global standard, and in 2013, the BRICS created the new development bank to compete with the World Bank from a reserve status. They are potentially making a new currency, a common currency amongst the BRIC nations, which are the emerging markets, to use a new currency in international trade. In 2014, China signs international trade agreements with Canada, Great Britain, and the entire Eurozone to use non-US dollar transactions in international trade. What this means is that some of our historically great and amazing economic, military, and allies from a political standpoint have signed agreements to use non-US dollar transactions. That would not have happened 15 years ago, but the U.S. is in a different position than it was 15 years ago. Our foreign policy is not as strong today. And I'm not saying that as an indictment. I'm just saying it's not as forceful, it's not as strong as it once was. Economically, we don't live in the same world that we did 15 years ago. Technology has advanced to the level that now, instead of just paper currencies out there, you have all these other fractional currencies being created. You have cryptocurrencies being created. The world is just in a different place right now, and it doesn't make a lot of sense for the rest of the world to use one currency that's tied to one nation, which means that if the U.S. struggles in any capacity, everybody else struggles in the world, and so the rest of the world it plays victim to the U.S. and the U.S. dollar specifically, and they want to move away from that. And so China is forcing the issue through these international trade agreements, through the petrodollar being ended. You have the IMF that is really spotlighting the SDR, which is special drawing rights, and you're starting to see the IMF really use the SDR in ways that a reserve currency would be used. The RMB, which is the renminbi, the Chinese currency, should be and will most likely be included in the valuation of the SDR. These are all things that are happening right now, and they lead to a conclusion, ladies and gentlemen, and the conclusion is quite simply the US dollar will end its dominance as the world's number one currency, the number one utilized currency, the number one reserve currency, which has allowed the US the unmitigated approach of printing as much money as they want, because they do what's called printing against debt. The rest of the world doesn't want that to happen because it gives them an unfair advantage in monetary policy, in economic policy, and so we're simply moving away from that. And the sooner that we as the American consumer and citizen can accept that, the easier it's going to be for us to protect it, to diversify from it. So when these things happen and the dollar continually declines in value, we're not getting hurt from a consumer economic standpoint, because we leverage our money to create more money. And that's why the forex market is so important. It's an amazing market. It's the number one most liquid market in the world, but for all these reasons that we talked about, because given the understanding of the history of the US and what's happening right now from a world stage, allows us the mindset to get out there and really truly learn about what's going on in the marketplace so that we can take advantage of it. But at the end of the day, the forex market is simply the global currency market. It's the international trading market. It is a very unique market because it's not centralized in just one location. It has these major banks that all the money flows through, from the IMF to the World Bank to the Sydney or the Tokyo or the London or the New York banks. The currency market is open up 24 hours a day because you always have a bank that is open out throughout the world. For example, when it's 5 o'clock and the US banks are shutting down Eastern Standard Time, it's 8 in the morning in Australia and the Australian banks are opening up. And so you always have these banks that are open up, which creates a 24-hour trading environment, which is beneficial because you do not have gaps in the currency market during the week. You sometimes have a gap on the weekend, but it's minimal. Gaps throw off traders' perspective, and so gaps can be a negative, they can be a positive, but they are an uncertainty in the stock and the options market. In the currency market, we really don't deal with that uncertainty. That's a very big benefit. Also, when you're day trading or swing trading, trading in the currency market is a little easier than trading in the stock and the options market, where you have to get a little bit more creative with order entry. Order entry in the currency market is truly just one click and done. It's instant fill rates. You don't pay a commission. It's 24 hours. That's what this market is, and that's one of the reasons the 24-hour period is one of the reasons why a lot of traders, of retail traders like myself and others, are gravitating towards the forex market, because it's an easier market to actually trade aggressively in. We participate in this market from a speculative point of view. What that means is the word speculation. What it means is, as a trader, we are speculating on the direction. It does not mean uncertainty. It doesn't mean gamble. It doesn't mean risky. It simply means direction. It's the same thing about the stock market. When you buy a stock, you're speculating that it goes up. When you short a stock, you're speculating that it goes down. If you have a retirement account, such as a 401k, you're speculating the market's going to go up. well, when it goes down, you lose money. It just means direction, and that's how we treat this market, as a directional market. Now, you have different types of forex systems in the world today. The first one is called a dollarization or a euroization system. This is where one country formally adopts another currency as a form of accepted currency in local markets. For example, if you have US dollars and you're in France, you can't buy a cup of tea with US dollars in France. You have to convert that to euros to do that. Well, if say France said, well, you know what? We're not going to use the euro anymore. We're going to accept the dollar. We're going to use the dollar in the local currency. You could use the dollar in their local markets. Zimbabwe is a famous or infamous example of that, where in 2009 the Zimbabwe dollar hyperinflated to a point of no coming back. They killed the currency and basically formally accepts U.S. dollars in Zimbabwe now. Eurozation is where they accept the euro, and that the famous one is in 1992 when the 28 member nations of the European Union formally accepted the euro, where 17 nations of the European Union, 17 of those nations now use the euro in the local markets. It's like Germany and France and Italy and Greece and Portugal and Spain and all these countries. They actually use the euro in their local marketplaces. So it's not it's not the number one system out there, but it is a system out there that does happen. The next one is called a pegged rate. A pegged rate is when one currency is pegged to the value of another currency. This is to aid importing, exporting, control inflation. A well-known example is the Chinese yuan was pegged for the last 15 years to the U.S. dollars. The Swiss franc was pegged to the euro for three and a half years, from 2011, mid 2011, until January of 2015, when the Swiss infamously removed the peg and caused tremendous amount of uncertainty in the Swiss franc and with the euro and with the dollar and with the yen. It caused a tremendous amount of volatility when you remove a peg, because when you have a peg, there's a certain amount of basic manipulation to a certain extent. And then you have the free floating currency system, which was established in 1971 when the US removed the gold standard from that equation. And basically now you have this free floating system where one currency is pitted against another currency in the form of a currency pair. The currency value is based on supply and demand. Economics really kind of drive the value of those currencies. And when you're dealing with the free floating currency, which all the major currencies are, when you're dealing with the free floating currency system, which once again is the number one system in the world, it's what 95% of the world is. You're dealing with just currencies that go up and currencies that go down, and the US dollar historically is one of those currencies that does go down over time. Now, the benefits of trading currencies: number one, leverage. Leverage allows you to take a little bit of money and control a whole lot of money. At 50 to 1 leverage, no other tradable instrument can compete with 50 to 1 leverage. What that means, if I put up $1, I control $50. If I put up $1,000, I control $50,000. It allows you to compete on a level that does not offer the retail investor in terms of trading stocks, which can be fairly expensive. Now, leverage can be a double-edged sword, as we talked about, being the fact that, if you put too much into a currency trade and it goes against you, that can be a painful experience. Next, 24-hour trading. 24-hour trading is, like we talked about just a second ago, very beneficial from a gapping situation, from an order entry standpoint, and from a news perspective. When news comes out, it is automatically priced into the currency, whereas it will create a gap in a stock. So 24-hour trading is a big benefit of trading currencies. Liquidity: over 5.3 trillion US dollars are exchanged every single day. Speed of execution, fill rates, very, very big benefit to trading when you deal with that much liquidity. It means it's not very manipulated. It's not easily manipulated. You see manipulation in all forms, in all tradable instruments, but probably you see it in the stock market a little easier, because when you deal with the four major tradable instruments: stocks, bonds, options, which are part of the stock market, the commodities market, and the currency market. The stock market is actually the smallest of those four markets by a large margin, which means you can manipulate it at the banking level or at a high frequency trading level. But in a currency market, it's not as easily manipulated, not even by the Goldman Sachs, Citibanks, Deutsche Banks, Barclays, JP Morgan, Citi, Bank of America. It's just not very, even at that level, it's not very easily manipulated. And then the lowest barrier to entry. Due to leverage, you can get into a trade for much cheaper. You can put $20 into a currency trade. You can put $100 million into a currency trade. It's a marketplace that is literally for people that are just starting out, for people that do not want to take a lot of risk, who don't want to put a lot of money into trades. And it's a marketplace that is one of the best markets for people with a significant amount of money from a protection perspective as well as from a trading perspective. And then this is a big one as well, searching for trades. There are only 7 major currencies analyzed, which means there's only 6 major currency pairs that we typically will deal with, and we will deal with that in the next segment of the Forex Trading 101 series presented by Tackle Trading. That is for Chapter 1. This is Matt Justice signing off for Tackle Trading, and we'll bring you another video next week in the Forex Trading 101 series.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.